Good evening. This is Doc Severson for the TheoTrade report for Tuesday, January 2nd. I'm cutting this video about an hour before the cash close, but most of the move has already been made for the day. So pending a sell-off in the last hour, what you see is what we've got for today. So let me ask you a question. Looking at the S&P 500 chart here, quick, which way is the trend? Well, it's to the upside, right? It's to the upside in the monthly, the weekly, and the daily chart. All of these have pretty serious uptrends. So why is it today that everybody wants to come into this market today and short the daylights out of it? Now, part of this might be due to how the market closed last Friday. So last Friday, we came into this market and after an early pop to the upside, we saw nothing but negative tape all day, and then just an absolute high volume punch to the downside to close out the day, the month, and the year. So I think that got a lot of people excited over the weekend, thinking that we were going to come into the new week, the new year, just absolutely selling off right out of the gate as penance for all those unwarranted gains from 2017. Look, one of the things that's been proven in trading psychology is the pain of missing out on the move, on a big move like this. The pain of missing out on a big move like this is actually much greater sitting on the sideline watching the move go on without you than it would be if you'd taken some type of a stop along the way. So losing actual money is less painful than sitting on the sidelines and watching one of these monster trends go to the upside without you. So what I've picked up from a lot of traders that I've talked to is this sort of sense of, well, I'm going to get you back. I'm going to short you as soon as we get into the next year. So there's almost a sense of vengeance trading that exists out there in the market because it shouldn't be up there. The valuations are way too high. When in fact, really none of that matters. And the point is that they got on the wrong side of the tape early on in the year, thinking that, oh man, wait until that guy makes one bad tweet and we're going to be sitting at S&P 1800 all over again. Well, it just didn't happen, and all that negativity got unwound to the upside. So a lot of guys came into this year thinking that, well, okay, now it's going to happen again. And so what do we get today? We get more upside today. So go back to what I said last week, is that when we have very strong years like this, it tends to follow that the subsequent year, the follow-on year, is not necessarily a banner year, but it's a very average year. So average over the last, 80 years or something like that is maybe as high as 12% on the S&P. A little higher than what people think, actually. And perhaps this has been colored from recent numbers, but typically what happens is the majority of the time when we have a strong year like this is that the follow-up year is modestly positive. Now, the other thing that I've noticed is that modestly positive year tends to come with a little bit of baggage. And this is what I find intriguing about looking at 2018. Now, when I say baggage to some people, they say, oh, well, that's great. Well, we're going to have the S&P down here at 2,000 in a couple of weeks. Yeah, that's what it deserves. No, not quite. So what we might have, at least statistically, what I found is that a lot of times when we get into the end of January, we get a little bit of pain, and maybe 3, 4, 5% of pain. Wait till you see what the media does with 3 to 4 to 5%. You won't believe it. You'll think it's Armageddon. You'll think that the market is absolutely coming to pieces based on how they're going to be positioning this thing, because frankly, they haven't had much to write about since the election. In fact, as of 2 weeks ago, all that CNBC could write about on their website was about Bitcoin. They couldn't even talk about the equity markets anymore. They're getting bored with this. So wait until you see what 3% of downside will do to the financial press. Now, those of you that understand how to trade through this, how to look through these, will find this to be a great opportunity, because markets do not just correct from the top and just drop like a stone like this. What they do is they transition from quiet and trending into more volatility first before they even think about transitioning to the downside. Market tops are always a process. So what you're going to find me doing is if and when we do get that 3 to 5% move to the downside, I'm going to step right in front of that freight train and be looking to sell long delta positions, whether that's selling premium through spreads, selling cash secured puts. In any case, what I'm going to be doing is selling into that spike to the downside, because if we let the probability speak for us, more than likely, at least we're going to get some type of a bounce off of that, even if it generates a lower high in time. Now, the second point I want to bring up today is I look at a chart like this, like Caterpillar, and based on what's been beaten into my head over the years is that you never buy the highs. You always wait for a pullback. You wait for a better reward to risk entry. You never buy something at the highs. Now, I know there's various schools of thought that go back to the 1920s and Jesse Livermore, etc., or even Investors Business Daily that say, hey, go ahead and buy the highs because new highs equates to more new highs. In my way of thinking, patience always pays off if you buy the pullback instead of just buying the highs and chasing after it. That's the problem. I never want to feel like I'm chasing after a position. I always want to feel like I'm taking the contrarian entry to a position. So we've been looking at charts like this all year long, whether it's Caterpillar or whether it's Boeing or whether it's NVIDIA, it doesn't matter. There's a ton of these charts that are out there. And what we've talked about lately is what's happening here is that these are all algo driven. These are all driven by algorithms based on computers that are emotionless and honestly don't care about whether they're buying the highs or not. They're just buying momentum, and just momentum begets momentum, right? It just keeps on going until it doesn't. So in 2018, I'm going to have to get over this. If I want to participate in any of these momentum movements, I'm going to have to get over this and have to transition and move along with the times. And one of the ways to do that is to kind of forget about this monthly chart, because the monthly chart is just way too extended. I look at that and I say, well, there's no way I can get involved in that. Even on the weekly chart, no way I can get involved in that. But if we drill down to the daily chart, or in some cases even a smaller time frame chart than this, we can start to see some edge. So let's spread this out a little bit and we can start to see some edge here. Now, one of the things that I've always believed in is this mantra of range contraction equals range expansion, or leads to range expansion. So what we're looking at here is every time we have a high degree of energy that's built up, and on the fractal energy study here, high degree of energy means that there's a lot of non-linear price action. This means that it's just coiling up. It's like a spring being tightened, all along here. So when we see situations like this, we will go ahead and buy into the highs. Now, what I want to do is I don't want to just buy these stocks in at the highs. What I want to do is use limited risk spreads, right? So I've defined my risk from day one on these charts. And I'm going to look for periods where we have high degrees of energy and breakouts above certain price levels. And I just want to take myself into the trade, not think too hard about it, because this is the way that price is moving. So if we go back and look at this, every time that we've had a high degree of energy, this has led to, again, upward movement in these momentum stocks. High degree of energy leads to breakout and high degree of movement. High levels of energy, sideways price movements has led to into new highs, right? So you have to get over this bias of not setting up the trade into new highs. I have to get over that. So that's my challenge for 2018, is look for these consolidation setups on strong momentum stocks that are screaming to the upside. At some point, yes, of course, we're going to have some corrective movement coming into this, as basically it's going to run out of buyers. And of course, I'm not going to be buying at these levels here into exhaustion, so I have to wait for the next setup. But that's one of my big changes for me and my trading plan for 2018 is identifying these momentum stocks, identifying the consolidation up against the highs, and not being afraid to take yourself into a momentum trade with a limited risk vertical spread. That is it for today's report, folks. Thanks for listening. We'll see you tomorrow.